Hey, how's it going, insiders? We're at a very critical moment in the US equity market right now. Based on the historical data, whenever the CPI number year-over-year increase hits above 4%, the average return for S&P 500 over the next 12 months was 13.8%. Right now, since January, S&P 500 has gone up 13.7%, reaching exactly the historical average return by the end of May. Also, if we look at the technicals, S&P 500 has formed this 2-month resistance exactly at this 14% year-to-date return level, and we just hit this resistance level for the 4th time over the past 6 weeks. As we're moving into the second half of 2021 and more uncertainties are coming up, where the market will go next from here will become extremely crucial on how much money you can make from this entire year. So that's why I want to make this quick video, share with you guys a couple of very important markets that are ready to break out, and those breakouts will give us some extremely important clues on which direction the stock market will go next. Also, by the end of the video, I will share with you guys one of my favorite investment ideas that I'm watching closely and been buying recently. Alright, let's get started. If you are familiar with macro finance, you will know that at the end of the day, there are only 2 factors that will drive the stock price. First is the corporate earnings expectations. Remember, the key word is expectation, not the actual earnings, because all the actual earnings have been already priced in. And the second factor is the interest rate. Let's take a look at the first factor, the corporate earnings expectations. So how do we track this expectation? Well, one of the best ways, and also the easiest way, is to look at the US dollars. If we look at this chart, we can clearly see that whenever the US dollar started going up, the US corporate earnings will be stuck in a range, or even going down. But on the other hand, when the US dollar started going down, the corporate earnings will go up. So the dollar index can work as a very effective leading indicator on the US corporate earnings expectations, which can directly drive the US equity market price. This is the monthly chart of the US dollar index over the past 35 years. As we can see, from 1986 to 1992, we had a major dollar bear market, which lasted about 6 years, and followed by a 10-year dollar bull market all the way to 2002. And after that, we entered another 6-year dollar bear market to 2008, and followed by a new 12-year dollar bull market until 2020 when the COVID crisis hit. So basically, the US dollar has been following exactly the same super cycle with this pattern, which is a 6-year bear market followed by a roughly 10-year bull market pattern, and then repeat this pattern on the way down. Right now, after the Federal Reserve decided to print over $5 trillion over the next 12 months, the dollar has officially entered a new bear market. If the dollar supercycle repeats one more time, we can expect the dollar will go down a lot lower over the next 5 years, which is a bullish sign for the stocks. Let's zoom in even closer and take a look at what is going on the weekly chart. Over the past 5 years, from 2015 to this year, the dollar has been basically stuck in this range. And right now, the dollar looks like it's trying to break this support level and go lower. If this support level breaks over the next couple of weeks, we should expect the dollar will go down a lot lower in a much faster pace, which can potentially drive the equity price a lot higher from here. But if the dollar fails breaking this level, and instead it goes back up to test the resistance, then we should expect the S&P 500 is going to struggle for at least a few months. So now the key question is, will the dollar break this support, and when? To answer this question, we need to zoom in even closer and look at the daily chart. On the daily chart, we're having some pretty mixed signals right now. From November 2020 to early of this year, the dollar had a pretty nice short-term downtrend and tried to break this support level, but it failed. The short-term downtrend was broken and the dollar went back up again. And interestingly, from last month, exactly the same pattern repeated again. The dollar formed another short-term downtrend, trying to break this support level one more time, but unfortunately it failed again. And now, we're having an early signal that this short-term dollar downtrend could potentially be broken, but it is not confirmed yet. So we're at an extremely interesting and also extremely crucial moment in this US dollar index. Although over the long term, the dollar will go a lot lower, as we just saw in the monthly chart, but what we care about over the short term, the dollar could go both ways. And each way is going to have a very dramatically different impact on the equity price for the rest of 2021. So this potential breakout to the downside on the US dollar is one of the most important breakouts that you should be watching very closely every single day. Apart from the corporate earnings expectations, another major macro factor that drives the equity price is the interest rate. From the Fed policies to the cost of capital, where the interest rate goes can significantly impact the direction of the stock market. And that leads us to the US Treasury market, which is also considered the smart money market. This is the monthly chart of the 10-year US Treasury yield over the past 30 years. As we can see, the Treasury yield is basically in a massive downtrend on its way to zero over the past 3 decades. So what does this tell us? Simply put, just one thing. The central bank does not want to see a high yield environment because when the yield is too high, it will completely break the stock market. But how high is too high and where are we right now? Let's look at the more recent years. Since 2019, when the yield hits the upper resistance, which was around 3%, it has been crashing massively ever since. Especially when the COVID crisis hit in 2020, the yield crashed to almost zero and trying to touch the lower support of this trend channel. But since the end of the 2020 and especially the early of this year in 2021, we can see that the yield is actually going back up. It was mainly driven by the high inflation concerns. Higher inflation expectations usually drive the Treasury yield going up. If the yield keeps going up from here, we should expect it will break 2% and then retest the upper resistance again. If that happens, it will create a lot of pressure on the stock market, especially those high growth stocks. And that is definitely a short-term very bearish signal that we don't want to see. So now the key question is where the Treasury yield will most likely be going over the next 6 months. Let's zoom in closer and see if we can find any clues in the daily chart. The Treasury yield has been in a clear short-term uptrend since the mid-2020. From August to October, we can see the yield formed this perfect 2-month triangle pattern followed by a strong breakout and the yield went up 52%. After the strong breakout, the same pattern repeated again. From November to January, the yield perfectly formed another 2-month triangle pattern and followed by a strong breakout, and this time the yield went up 92%, almost doubled. And right now, from April, we're forming this exact same triangle pattern one more time. We're almost at the end of the triangle pattern and are ready to break out. If the yield repeats the same pattern and the breakout from here to the upside, then we should expect the yield could go a lot higher. And that is definitely a very bearish signal to the stock market. But not all the stocks. It will hurt those high-growth tech stocks the most and accelerate the rotation from growth to value even faster, especially those financial stocks will actually benefit from this Treasury yield breakout. But if the yield breaks the triangle pattern to the downside, that will actually give a lot more rooms for the equity market to run up. And especially for those tech stocks which been hurt really bad recently, we can expect that they could have a pretty good comeback and a lot of money can be made from buying the dips in the high-growth tech sectors. For now, unfortunately, most of the smart monies like Michael Burry and Ray Dalio are all betting big on the yield will keep going up from here. In fact, betting yield going up and shorting the treasuries is one of the most popular trades among institutional investors to bet on inflation and at the same time to hedge their equity positions. Which means most of the smart money strongly believe that inflation is here to stay, or even potentially getting worse in the near future. And that would drive the Treasury yield goes a lot higher from here before the Federal Reserve eventually steps in. So guys, that is why this potential breakout of the 10-year Treasury yield, especially the breakout to the upside, deserve all of our attentions. Oh, by the way, if you like what you're learning in this video so far and find it valuable, please let me know in the comment section below. I would love to hear from you guys. And also, please help me hit that like button. It can really help this channel grow. Another very important breakout that deserves our attention, which I also believe is one of the best investment opportunities over the next 5 years, is the crude oil. Before we jump into the charts, I just want to quickly share with you guys why having oil stocks in your portfolio right now is extremely important, and actually even more important than buying tech stocks, especially right now in our current macro environment. Well, simply put, there are mainly 2 reasons why having oil stocks is important. First, oil stocks are definitely one of the best, if it's not the best instruments that we can have right now to hedge against inflation, especially the type of inflation that is created by the combination of both supply and demand imbalance and the massive monetary expansion, which is exactly the type of inflation that we are having right now. Second, oil stock is your only effective choice among all the S&P 500 stocks to hedge against geopolitical risk, which will actually become bigger and bigger concerns around the world over the next 5 to 10 years. And if we look at our current macro environment, where both of the inflation risk and the geopolitical risk are heating up, oil stock is no longer a good to have, but a must have in any investor's portfolio. As we all know, the oil price goes in cycles. In fact, it always goes in a 10-year supercycle. This is the monthly chart of crude oil price over the past 20 years. From 1998 to 2008, it was a 10-year bull market for the crude oil. The price went up over 1,200%, and then followed by a 10-year bear market. And interestingly, right now, we just had a very interesting breakout to the upside from this massive 20-year triangle pattern. And that signals we're officially entering the early stage of a potential new supercycle in the crude oil market. So now the key question is, when is the best time to jump into the oil supercycle and make some serious money? Let's zoom in closer and see if we can find any good entry point on the daily chart. As we can see on the daily chart, after a really nice 4-month uptrend bull run, crude oil has perfectly formed this classic textbook cup and handle pattern. And right now, we're approaching the end of the pattern and are ready for a breakout. A cup and handle pattern is a very powerful bullish trend continuation pattern, which means we should expect a breakout from this resistance level pretty soon to the upside, and the oil price will go a lot higher from here. Because the entire energy sectors is one of the most undervalued sectors in the US, and they will be the ones actually going to benefit the most from the macro environment that we're heading into over the next 5 to 10 years. There will be a lot of serious money can be made with a very small amount of risk. So this potential breakout in the crude oil market is also an extremely important and also very exciting market for us to watch. Alright, that will be the end of this video. Please let me know in the comment section below if you enjoyed this video and learned something valuable. Also, if you want me to cover any other topics or markets or have any questions, please leave your comments below as well. Again, if you are new to this channel, my name is Vic. Thanks so much for watching, guys, and I will talk to you guys soon.